Buckle up, buttercups! China, the land of pandas and rapid skyscraper construction, has decided to shake things up by slashing interest rates. The People's Bank of China, PBOC, has given its key rates a significant haircut, a financial queer eye intervention, if you will. This isn't just a minor trim, it's a full-on economic makeover announced around May 7, 2025. China is desperate to get its economic engine revving again, hoping that making money cheaper to borrow will be the financial equivalent of a nitrous oxide boost. The decision to cut rates, particularly the 5-year loan prime rate, LPR, by 25 basis points, is a clear signal that Beijing is worried. When a global economic powerhouse like China gets worried, we all should probably pay attention. Why is China so keen on making money cheaper? Their roaring economy has developed some concerning coughs and splutters. For decades, China's economy was the Usain Bolt of global growth, but lately, it's been limping towards the finish line. One of the biggest headaches for Beijing is the alarming rise in youth unemployment. Imagine graduating with a fancy degree only to find the job market about as welcoming as a porcupine in a balloon factory. This isn't just an economic problem, it's a social tinderbox. Then there's the ongoing soap opera of the Chinese real estate market, now creaking under mountains of debt. The government is trying to manage a controlled demolition, but it's a delicate balancing act. All these factors combined paint a picture of an economy that desperately needs a shot in the arm, or in this case, a significant cut in interest rates. Faced with a gloomy economic prognosis, the People's Bank of China decided it was time to play doctor. Their prescription? A hefty dose of monetary easing, making money cheaper to borrow. The headline act was the cut to the 5-year loan prime rate, LPR, by 25 basis points. Alongside the LPR cut, they also slashed a key interest rate down to a startling 1.4%. The idea is to make it so tempting for businesses to borrow and invest, and for consumers to spend, that they simply can't resist. Furthermore, the central bank also lowered the reserve requirement ratio, RRR, for banks, freeing up more liquidity in the banking system. The grand plan is to kickstart the economy, boost aggregate demand, and steer away from recession. Whether this financial medicine will be strong enough remains to be seen, but they're certainly giving it their best shot. Why the sudden flurry of activity? The timing and decisiveness of these rate cuts tell us a lot about the level of concern within Beijing. This isn't just a routine checkup, it's more like the economy was rushed into the emergency room. The urgency stems from a confluence of problems: youth unemployment, the precarious state of the property market, and the slowdown in exports. These issues are interconnected, creating a negative feedback loop that can be incredibly difficult to break. The Chinese Communist Party's legitimacy relies on consistent economic growth and rising living standards. These economic measures are about ensuring the social contract remains intact and achieving broader strategic objectives. The urgency is about getting back on track to meet these goals, ensuring that the Chinese dream doesn't turn into a Chinese nap. Meanwhile, across the Pacific, Uncle Sam has been busy sharpening his tariff pitchfork. Just as China is trying to perform delicate economic surgery, the US has decided to add a little extra spice to the global trade environment. The US administration unveiled a fresh wave of tariffs targeting a range of Chinese goods, including electric vehicles, semiconductors, and medical goods. From China's perspective, these US tariffs are seen as economic warfare, a deliberate attempt to stymie China's rise. This escalating trade friction creates a hugely challenging environment for China as it tries to navigate its domestic economic slowdown. The tariffs add another layer of uncertainty for Chinese businesses, potentially hitting their export revenues. While China is busy trying to stimulate domestic demand with rate cuts, it's also having to fend off external pressures. The relationship between the world's two largest economies is looking decidedly frosty. Are China's recent interest rate cuts a direct strategic counterpunch to these new US tariffs? The truth is probably a bit of both. The timing certainly looks like a response. By making borrowing cheaper and stimulating domestic activity, China could be trying to offset some of the negative impacts of the tariffs. A potentially weaker yuan could make Chinese exports slightly cheaper and more competitive globally. However, the primary driver for these rate cuts is likely China's pressing domestic economic woes. The rate cuts might offer some indirect benefits in the context of the trade war, but their fundamental purpose is aimed at shoring up China's internal economic foundations. It's a delicate dance, managing domestic stability while navigating an increasingly hostile international trade environment. How does China fiddling with its interest rates and squabbling with the US over tariffs affect you? In our hyper-connected world, when an economic giant like China sneezes, the rest of the globe potentially gets full-blown pneumonia. China's rate cuts could boost sentiment and lift markets, especially those with exposure to China. However, the need for such significant cuts could also spook investors. A weaker yuan makes Chinese exports cheaper, affecting competitors in other countries and making imports into China more expensive. The US-China trade tensions have already caused massive disruptions to supply chains. Further escalation could accelerate shifts in these chains, potentially leading to higher costs for consumers. What happens in Beijing and Washington definitely doesn't stay in Beijing and Washington. These grand economic maneuvers don't just happen by magic. There are actual human beings pulling the levers behind the curtain. At the forefront is Pan Gongsheng, the governor of the People's Bank of China. Governor Pan and his colleagues at the PBOC make the call on things like interest rates and reserve requirement ratios. These officials are deeply involved in crafting the broader economic strategy for the nation. In China's top-down system, major economic decisions are coordinated efforts involving various government bodies and the highest levels of the Communist Party leadership. The challenge for these officials is immense, dealing with a complex, transitioning economy facing both structural domestic issues and significant external pressures. The success or failure of these policies will have profound implications for the rest of the world. What does all this mean for the future? The global economy is in for a bumpy ride. If China's rate cuts work as intended, we could see a resurgence in Chinese growth, boosting demand for commodities and goods from other countries. However, if these measures aren't enough, China could face a prolonged period of sluggish growth, dragging down global growth. The US-China trade war adds another layer of unpredictability. If tensions continue to escalate, we could see further disruptions to trade and investment flows. Alternatively, economic pressures could lead to some kind of uneasy truce or renewed effort to find common ground. The next few years are unlikely to be boring. Keep an eye on the headlines and maybe stock up on popcorn. It's going to be quite a show.